What eventually brings prices down? Do you think we get to the point where there's more production? Does that happen more quickly, or demand destruction? Because there's only two ways to deal with it, demand or supply.
Yeah, so historical a commodity market would balance with supply elasticity to prices, inventory as a buffer, and then demand elasticity. Today, the supply elasticity is close to nil, right? Shale producers are doing as much as they can, especially given the service sector tightness that they face. And investment elsewhere is a multi-year investment. So we're down to that last component, demand elasticity. So when you think about oil prices, you really have to think about, are we at the price yet where I slow demand growth enough to stop this record long deficit? And that's really the function of prices. And that's why, sure, on a 2-3 year horizon, high sustained prices help. But I think what we have to worry about for the next few months is, how do you achieve that sufficient demand destruction?
With this happening at the same time that the Fed is trying to bring down demand to deal with the supply chain issues we've seen, again, the only thing that they can do is hurt demand. They can't fix the supply side of things. Does this put us in a position, you think, of right now the economy's kind of soaring here in the United States, going along. Consumer demand is really strong. Does this put us in a position where it's really strong until the bottom just drops out for everything and we crash?
Yeah, it's not a big case, but I think that's the risk we have to worry about, right? If I think in economic term, the output gap, so my ability to produce, is tighter in energy than anywhere else likely in the economy. So you can have tightening financial conditions from the Fed, from financial markets, but if you don't have the diesel that runs the global economy, you're going to have to stop growth much sooner. So, it's not our base case, but when you worry about the potential further declines in Russian exports, I think that's a non-negligible risk that we have to keep in mind. But as you stated, we're not there yet from a pricing perspective with this strong momentum, seasonality, people wanting to fly this summer. So there needs to be another leg higher in prices. Our forecast for Brent is 125 starting this summer.
Your forecast for Brent is 125, and you think that that's the tipping point where consumer demand drops off because people aren't going to drive, they're not going to fly, prices will go up too much. What does that mean for transportation and just getting things places?
So the idea is that it slows growth, right? We're not yet arguing that we need to see outright declines in demand. But at that price point, on the margin, people drive a bit less. What's going to be difficult this year are, two challenges. On the one hand, some of the demand will be quite resilient to higher prices, right? Again, think about people flying this summer. If they haven't flown in years, that demand is relatively not price sensitive. Second, governments will try to too. Right, and governments will try to help on gasoline, reducing taxes. So that's the challenge on the one hand. The second, then, big uncertainty is Russia, right? Russia is a big exporter of diesel. If we lose a lot more of diesel, what drives the global economy won't be there, and prices have to then rise even further. So I think that's really the two challenges you have to keep in mind. So, our initial estimate is 125 for Brent. Consumer prices, by the way, are higher, right? Especially in emerging markets due to the dollar. Let's see how that works. And, again, I think the risks I see as more to the upside than to the downside.